In this video, I'm going to be showing you the current...
Could you not?
In this video, I'm going to be showing you the current dividend stocks I'm watching in May 2020. Disclaimer, I'm not a financial advisor. If you seek financial advice, please see a licensed professional. From the end of the bull market where investor sentiment was very high to a looming recession within weeks and many people forecasting big crashes ahead. So that means there's currently a lot of value available in the market. And for UK investors, it's important to look around and see what is of high value currently. As the S&P 500, a lot of the companies involved in it have recovered to normal prices. In the UK, however, not so much. We're still lagging behind. And so that does mean there's still discounts and values to be found. So in this video, I'm going to show you which dividend stocks I'm watching in May 2020. Firstly, I'd like to talk about a company that has been extremely affected by the current climate. Its share price has been the lowest for 20 years. And also, it has been hit hard on this looming recession. We've seen the pandemic situation cause a sell-off in the markets, as well as a war in oil prices between Saudi Arabia and Russia, which has meant that this company has struggled. It means that their share price has seen great volatility and a large sell-off. And in the last 10 years, we've seen a big oil spill incident, which has meant that they've had to pay out 47 billion towards the people affected by the crisis, which was an oil rig about 10 years ago exactly now that had exploded and 11 souls were taken. And so that share is BP, British Petroleum, which is part of the 6 major oil companies in the world. And you may believe, well, BP, the oil prices just went negative a few months ago. How are they meant to make a profit in the long run? And what does this mean for investors? We really shouldn't buy that. That's risky. We don't want that. Well, BP don't just sell oil. And in fact, they won't sell it negatively at all. What they do is they are a fully furnished company, which means that they are able to turn the oil into gasoline, jet fuel, and other components of the oil which can be created through fractional distillation. And these products can be sold to third parties to make money. So they don't need to sell oil by the barrel. And in fact, they are lesser affected by this than a lot of the smaller companies in the region. And I do believe in the future there is a lot to capitalise off of these energy companies. It is worth noting that BP in the future look towards going towards carbon zero, which means they want to emit as little as possible carbon from their process and look towards going more green friendly, perhaps even looking more into solar energy and other types. And they've actually pushed away from the other oil companies as they typically want to stick with oil. BP has shown that it is resisting that and wants to set a new path. In recent years, they've managed to increase their net cash flow by a considerable amount, and this company, whilst yes, its dividend payment is at risk and a lot more than certain other oil companies. However, in the long term, I do not feel that this company will go out of business. And yes, they do have to sell oil if they do sell oil by the barrel, they have to sell it at $55 just to make a profit. But that's not what they're currently doing. And they're going to use the other side products from their distillation of oil and make a profit that way. So this company is incredibly weathered to survive this current pandemic crisis and potential crash/recession incoming. And in fact, it's worth noting that if BP does suspend or cancel their dividend, in the long term, I still believe in the company. And suspending their dividend means that they are able to increase the amount of cash they have available and therefore are much more likely and have a much higher percentage of surviving this situation. So that's the first company I'm watching. If you're interested to see weekly portfolio updates, what I'm buying and what I'm watching monthly, click the subscribe button. So Aviva is actually the next company on this list, and you may think, why am I watching it if I already own it? Well, I'm looking at the share price quite closely because currently it's dipping very low. It's continued to fall quite heavily, whereas some of the market has recovered. Aviva it's either flattened or fallen further. And their share price is at a very, very low point and very high value to the investor. Currently their dividend is suspended, but in future they plan to bring that back. And it was because the Bank of England and regulatory authorities in Europe and England has completely stressed on the situation of these financial companies holding as much cash as possible. And they've suggested that they evaluate their financial position, as there could be a lot of claims after this situation. And personally, I'm looking to buy this company. If it dips lower than £2.25, I'll be able to average down on this investment and have a bigger allocation. They do plan to resume their dividend later this year, providing that the situation has eased up. So that is worth noting, and Aviva was a big dividend payer. It's also worth noting that insurance companies are weathered to survive situations like this, so no doubt Aviva will survive this. They may have a fall in revenue in the next few years, however in the long term, being a life insurance company and going with the ageing population, it means that they are actually going to thrive. If you'd like to know which dividend stocks I bought last month, then click the card at the top right of the screen. Next, I've been looking at a more resistant, defensive stock that isn't impacted that much by certain sectors being unavailable, such as hospitality, for instance. And the stock I've been looking at is Unilever, which is another stock I own, but it is worth watching because Unilever are weathered. They've got this wide moat and it's very hard for competitors to compete with them. And I guarantee you, in 90% of households in the UK, you're likely to have at least one product from Unilever. Like if you go through your cupboards, for instance, and look at the brands of it, like Marmite, for instance, Axe body spray, you'll likely find out that it's from Unilever. And a lot of these products are consumer staples, and they're very likely to have the same demand through recessions and pandemic situations, if not increased demand right now. You pay a premium for this stock and you get a dividend yield of around 3%. You won't see their share price drop by as much as other companies, so they have a lower volatility. And personally, I'm going to watch this stock, and if it goes below £40, I'm definitely going to add more allocation to my portfolio. And in the future, I'm going to invest a lump sum in the coming week. I do plan on expanding my position with Unilever. So all of these stocks I do plan on watching throughout the next month. And I know for certain that I'll want to buy more of Aviva and Unilever, but once they've hit valued prices. BP is a company I'm looking at to see if I can diversify my energy sector, as currently I'm only running with one oil company in the energy sector, and some diversification will be healthy. And we won't know what the market will do in the future, so I guess we're just going to have to wait, sit down and watch and see what happens. But these are some of the companies I'm going to be watching. Thank you for watching. I'm Osborne Foreman. Have a good night.